Assalamu alaikum. We've done savings accounts and we have completed fixed deposits. Yesterday we went through those examples, right? So today we're moving on to check or current account, also known as a transactional account, right? So this type of an account is the one where you run, where you have your debit card on and your credit card on, and then you're using it to make payments. And you sometimes, if you earn a salary, your income or your salary goes into your account and your expenses get paid into an account. That's why there's a lot of transactions, and they call current accounts because we're using them all the time, and transactional accounts, right? So the advantages here, there's flexibility. These are accounts held for purpose of providing funds for withdrawal or payment in variety of forms, including checks, stop orders, debit orders, electronic and or telephonic transfers. So this is the one where you can draw checks on. You can put in a stop order or a debit order to pay something that you pay every month. You can do an electronic or a telephonic transfer, which means you can do an EFT from your account to somebody that you're paying, right? So the disadvantage here is they tend not to earn interest but attract high interest rates and penalties if they are overdrawn, right? So you don't actually keep this account like how we had the savings and the fixed deposit account. You're not keeping the money there to earn interest or to earn an income. What you're doing is keeping it in there to do all your transactions, all your payments, and get to receive your salary or your income in, right? So this says here that it attracts high interest rates and penalties is if overdrawn, right? So this means it's a bank overdraft. So what happens is that the bank gives you a facility. Say for example, if you have only 10,000 Rand in your check account, they give you an overdraft facility where you're allowed to use your account more than what money you have, and then they start charging you interest on that money that you have used. So it means you have overdrawn your bank account and you're using your bank overdraft facility, which is not a very good idea because they charge you a very high interest rate, and it means you don't even have that money. You're actually spending money that you don't have, and then you have to pay the interest as well, and then there's penalties if you don't pay the interest back, right? So that's a big disadvantage of that overdraft. Another advantage, transactional accounts are meant neither for the purpose of earning money nor for saving, but for the convenience of business or personal client, right? So the business can use their account to get everybody to put in the money, whoever's paying them, and all the customers to put in their money in there. Or if it's your own personal check account, you can get your salary put into it and then you use it to pay all your expenses. And nowadays it's quite easy with EFT, where you just click onto your online banking and you can transfer money within seconds, right? Another disadvantage, interest on these types of accounts is calculated daily but only paid into the account at the end of the month. So you can earn interest on your balance that is there, but they're saying that a disadvantage is that you earn it only at the end of the month, right? But your intention of keeping a check account is not focusing on the interest. So this is the normal bank statements that we have done quite a few in class, so I'm not going through an example. You can turn back to your textbook and look for a bank statement and look through the questions we've done. We went over it, we revised it, and you did it in your test, so you are quite familiar with that one, right? And I'm moving on now to this part here where it says credit cards. Okay, so you need to understand what is a credit card and how do we get a credit card, right? So let's read the advantages. A credit card allows you to buy goods and services now and pay for them later, right? So what this means is that you're not actually paying for, when you go to the shop and if you swipe your credit card, you haven't actually paid for those goods or services that you have used. You haven't paid that person. Actually, the bank has paid that person and you're owing them that money, right? Because it doesn't mean the amount is withdrawn out of your account, okay? So each card is given a specified credit limit which you can use to buy goods and services. So that's a disadvantage. So what happens is when you go to the bank, they check your credit history, they check your salary, and according to that they give you a credit limit. So the credit limit means that's the amount. For instance, if it's 30,000 Rand, that is the amount you can spend on your credit card. It doesn't mean that you have that much amount of money in your bank account. It means that you are allowed to spend that much money on your credit card, then they give you a date by which you need to pay those amounts or part of that amount. Otherwise, they start charging you interest. So it's like taking a small loan and you're using their credit facility. This is not a disadvantage if you ask me. It's an advantage because they do give you a credit limit. It's a disadvantage because they're limiting your credit limit. But if, say for instance, you're earning 20,000 Rand and the bank gives you 100,000 Rand credit limit, what's going to happen? You're going to go into huge debt and you're not going to be able to pay it back, right? And you're going to max your credit card out and then you're going to be in big trouble. So your credit limit keeps you within a range where they know you are able to pay it back, right? Transactional accounts are meant neither for the purpose of earning money nor saving, but for the convenience of the business or personal clients. So same thing like the check account. Your credit card is there for you to make it easy for you to use for your transactions, right? This borrowed money must be paid back within a specified time period, or else the cardholder will have to pay very high interest rates. So it happens that if you don't pay, we'll look on the statement now. If you don't pay within the due date, they start charging you very, very high interest rates. So it's a huge disadvantage there. Interest rates on most credit cards are personalized and appear on the client's statement, right? So if you will look through the statement now, credit cards are not designed for savings. That's a disadvantage. They offer low interest rates on credit balances and charge high interest rates on debit balances, which means that if you have money in your, if you're putting extra money into your credit card, you earn a very low interest rate. But if you've used your credit card quite a bit and you're owing them money and you're being charged interest, it's a very high interest rate. So it's a disadvantage there, right? So let's go through this example here. Okay, so if you look at this one here, right, this one here is the credit card statement. So this is the bank sending you a credit card statement. This is Mr. Mike's credit card. This is his credit card statement. You remember we also looked through this before. This one says a statement date 25th of July 2011, payment due date 19th of August, and his account number. Now he has a straight facility and it's giving you a summary. So that means he's not using, you remember we did the budget facility, so he is using the straight facility, right? So the questions are on the other page. I'll just read you the question. The question says, is the opening balance on Mike's account a debit balance or credit balance, and give a reason for your answer. Okay, so then you see this one here, this bank is putting in a credit there when he's putting money into his credit card. So this is his payment into his credit card, which means all the rest of them are all debit balances. So it means that he has a debit balance there and he's owing the bank 4704.50, right? So now it says, explain why the closing balance and the available balance are two different totals. So where's his closing balance? 10,540.61 and 14, it's his available balance. What's the difference between these two here? The closing balance is what Mike now owes the bank. Okay, so he needs to pay them 10,504, right? And the available balance is the amount of credit he still has, which means that he can go to the shop and use his credit card for that amount of money. Okay, so if you look here on the top, okay, it's showing you that his limit for his credit card is 24,978. So he can only use his credit card for that amount, right? So then, so his closing balance was 10,504 and his available balance is 14,036. So this is the amount they calculate that he needs to pay them now at the moment, right? So let's go to the next question, and it says, show how the bank calculated the closing balance. How did they calculate the closing balance? They took 4704.50, which is the opening balance. They added 15,749, which was what he used for the what he used his credit card for. Then 50.72, which is the interest. Okay, so this is actually added together, right? This is what he used his credit card for. That's the interest that they've charged him, okay, because he hasn't paid that balance there. And then they're minusing 10,000 Rand, because what has he done here? He's paid 10,000 Rand into his credit card facility, and that's how they come to 1054 also. This is the amount he's owing the bank, that he needs to do a payment for that amount, and this is the facility that he's allowed to use. Okay, so let's look at the next question. It says, explain what is meant by minimum payment due. So minimum payment due, we did this before as well. It's the what question is that one? Sorry, that's minimum payment is number 4. Mike owes the bank 10,540.61. The bank will allow him to pay this off in monthly installments, which include interest at his personalized rate of interest charged on debit balances. So he owes that money, but he's allowed to pay a minimum payment of this much here, okay, of 526 Rand. So it's not actually a good idea because you're getting charged all the time. So you should try to pay your credit card as you go along so that you're not being charged interest, right? So 5B says, what was it a good idea for Mike to use his credit card to buy fuel in August? So let's go to August. Where did he buy fuel? 555 Rand here. He bought fuel. No, Mike's account had a debit balance, which means that he will be charged interest on his purchase of fuel. If he had a credit balance, he would not have been charged interest. Okay, that's a bit of a silly question because you can't live without fuel. You should have used a luxury item. So anyway, if he buys that 555 Rand worth of fuel, it's getting added onto his debit balance, and it's making his credit card earn more money. So what you need to understand is that when you have a bank account, you have a separate credit card facility and a separate statement as compared to your bank statement where we did this check account here. So what happens is they give you a limit, right? So you allowed to spend 24,978 on there. Okay, so that's the limit, the amount of money that you can spend on your credit card. Once you start spending money on your credit card, you need to do payments from your check account into your credit card facility to start paying back that amount that you have used. And when you don't follow the payment due dates, which is this one is example 19th of August, then if you go over the due date, then they start charging you interest. So it's not a good idea to get charged the interest. You can nowadays, it's a good idea to keep a credit card because you have this e-bucks facility and you get a lot of advantages and rewards. When you book a plane ticket, you can use your e-bucks and to buy some stuff, so you're collecting points. So you should try to keep a good credit history and not pay too much of interest. Okay, the last thing that we need to do for banking is debit cards.